You're watching Silver News Daily. Subscribe for more. Did you know that silver could skyrocket to $2,000? It sounds unbelievable, right? But according to Rick Rule, a renowned expert in precious metals, this explosive growth is not just possible, it's imminent. In today's video, we're diving deep into the key market factors that Rule believes will drive silver prices through the roof. You need to hear this before making your next investment move, so stay tuned.
People ask me to set a target, and I kind of say, I don't have one. What I do have is a belief that for reasons that I understand and reasons that have valid historical context, that the preponderance of evidence says that the gold price will go higher and perhaps materially higher. That's probably all people need to know. That's as certain as they're going to really be able to get in life. If you look at the historic relationship then between gold markets and silver markets, it is likely, if past as prologue, that at some point in time in this gold bull market, that silver will move further and faster. It's true, too, if you've observed the last four markets, that when silver establishes price leadership, that the most volatile of all precious metals asset classes is the silver stocks.
So, Rick, I want to ask you about equity valuations now. Mining, as we both know, is an extremely complex business. There's so much to consider, including metallurgy, grade, size, geopolitics is always a big one. So many elements which can impact a company's profitability. And when you look at Newmont, for example, the world's largest gold producer, it's it's up about 2% on the year. Okay. At the same time, where gold is up over 20% on the year. Barrick, the world's second largest gold producer, it's actually down 2% on the year. But like I said, gold is up 20% on the year. Why do we have this discrepancy between the physical and what some of these equities are trading at?
Three things, I think. The buyers in the gold market for the last 2 years have been central banks. They buy gold, not gold stocks. So while there's been a motivated buyer on one side of the equation, that motivated buyer, the buyer with the cash, hasn't cared about the other asset class. In the near term, that's probably the most important dynamic at play in the delta between the gold equities and the gold stocks. The second is that although the gold price has increased, and one would expect as a consequence of the product price increasing that the margins would increase, the costs associated with producing an ounce of gold have increased too. The social expense, which is to say taxes, royalties, off-concession expenses, have been increasing at 30%.
Let's start by examining the current market conditions that are setting the stage for a potential silver explosion. Recently, silver prices have climbed significantly, reaching a daily high of $30.87. This surge is largely due to the anticipation of Federal Reserve rate cuts, as investors are betting on lower interest rates starting this September. Federal Reserve Chair Jerome Powell has reinforced this sentiment, sustaining lower U.S. Treasury yields. In this low-rate environment, silver, which offers no interest yield, becomes a more attractive investment. Additionally, the political landscape is adding to the excitement. The failed attempt on Donald Trump's life has paradoxically boosted his 2024 presidential campaign, raising expectations of reduced regulatory constraints under his potential administration. This has led investors to gravitate towards riskier assets, which could impact the momentum of traditionally safe assets like silver. Moreover, the U.S. dollar's recent strength, driven by anticipated policies under a Trump presidency that may inflate government debt and spur inflation, has also played a role in tempering silver's gains. However, the economic indicators are showing mixed signals. The latest data reveal a reduction in U.S. consumer prices, marking the first decline in over 4 years, with annual inflation cooling to 3% from 3.3% in May. Powell hinted that rate cuts could begin even before inflation hits the 2% target, aiming to stimulate economic activity by lowering borrowing costs. While a strong U.S. dollar might limit silver's rise, potential rate cuts could enhance its appeal as a hedge against inflation and economic volatility. Globally, optimism over Trump's possible re-election and rate cut prospects have fueled positive market sentiment, pushing Asian equities, like Japan's Nikkei 225 and South Korea's KOSPI, to significant gains. Yet this risk-on mood has somewhat restrained the progress of safe haven assets like silver. Investors are favoring higher risk assets in anticipation of regulatory easing and fiscal policies under a second Trump term, which has moderated silver's ascent. With these market dynamics at play, silver's current price momentum is a crucial factor to watch. The metal stands at $30.81, showing a moderate increase, with immediate resistance projected at $31.24. The 50-day and 200-day EMAs are at $30.84 and $30.38, respectively, indicating a potential bullish breakout if silver remains above the critical $30.87 pivot point. However, slipping below this threshold could trigger significant sell-offs. Understanding these market conditions is essential to grasp why Rick Rule sees a massive silver rally on the horizon.
And I suspect that this whole thesis that we've watched historically time and again in the gold equities markets over the last 50 years transpires, beginning slowly, fitfully, in 2024.
So Rick, let me take the other side of that argument, okay? And let's just say the central banks have been very aggressive in bidding the price up, okay? Do you think the central banks have created an artificial gold price and that maybe the equities are actually factoring the true price? So it's not $2,400, maybe it's $2,000, maybe it's $1,800 an ounce.
If I thought that the US government would cease the extraterritorial imposition of US power on other countries, I'd be partway to a yes. The rest of the yes would require me to believe that the deterioration of the purchasing power of the US dollar was going to abate, which is to say, I would have to believe that we would solve the debt and deficit problem, that the United States would have to solve the spending problem, that the United States would once again be able to sell US Treasuries to foreigners and not have to counterfeit, quantitatively ease the US dollar. And I don't believe that any of those are true. Because of that, I think that rather than being artificially high, what you have seen is that the foreign central banks were the first leg of buying, the first leg in the arbitrage between gold and US dollar denominated fiat savings products. One other piece of data that I think your listeners might be interested in, I probably used it on your show before, which is to say gold's market share. The market share of precious metals and precious metals related investments in the US market is about 0.5%, which is to say that less than 0.5% of total savings and investment assets in the United States are precious metals and precious metals related assets. The 4-decade mean market share is 2%. If gold merely reverts to mean, which is what I think is going to happen, demand for the stuff, by stuff I mean both precious metals and precious metals related investments, increases fourfold. And that's exactly what I think is going to happen.
Political influences are playing a substantial role in shaping the market sentiment for silver. One of the most surprising factors recently is the attempted assassination of Donald Trump, which has paradoxically bolstered his campaign for the 2024 presidential election. This unexpected event has led to a surge in Trump's popularity, and investors are speculating that a Trump administration might bring about significant changes to regulatory policies. The anticipation of Trump's potential re-election is causing a ripple effect in the market. Investors are betting on diminished regulatory constraints, which Trump has historically championed. This expectation is pushing them towards riskier assets, as they foresee a more business-friendly environment under his leadership. However, this shift towards riskier investments can also impact the demand for safe haven assets like silver. Traditionally, silver benefits from economic and political uncertainty, but in a scenario where regulatory constraints are expected to loosen, investors might divert their funds to equities and other high-risk assets, dampening silver's upward momentum. Moreover, the US dollar's recent strength is another factor to consider. The dollar has been buoyed by the anticipation of Trump's potential fiscal policies, which are expected to inflate government debt and spur inflation. A strong dollar typically restricts the gains in silver prices because it makes the metal more expensive for holders of other currencies. However, it's essential to note that while a robust dollar can temper silver's rise, the broader implications of increased government debt and inflation under a Trump administration could eventually turn investors back towards silver as a hedge against economic instability. The interplay between political events and market sentiment is complex. For example, if Trump's campaign continues to gain momentum, we might see a further shift towards riskier assets in the short term. However, the longer-term implications of his policies, particularly those that might drive inflation and increase government debt, could lead to a renewed interest in silver as a protective investment. Investors are acutely aware of these dynamics, and their strategies are evolving accordingly. Another aspect to consider is the international reaction to U.S. political events. Global markets are closely watching the developments in the U.S., and Trump's potential return to power is seen as a catalyst for significant economic shifts. Asian markets in particular have responded positively to the prospects of Trump's re-election, with major indices like Japan's Nikkei 225 and South Korea's KOSPI showing substantial gains. This optimism, however, has led to a somewhat restrained advancement for safe haven assets like silver, as investors flock to equities in anticipation of favorable economic policies. But how do these political dynamics tie into the broader economic indicators and global market sentiments that we discussed earlier? To fully understand the potential for silver to reach $2,000, we need to look at the economic indicators and their impact on the market. These indicators provide a clearer picture of how economic policies and political events are shaping investor behavior and influencing market trends. As we move forward, let's delve deeper into the economic factors that are at play, shedding more light on why experts like Rick Rule are so bullish on silver's future.
35 or 40% compounded. The energy costs of mining companies over 4 years have doubled. The labor costs are increasing at about 20% compounded. So the margin increase that you would hope to see as a consequence of a 20% increase in the gold price haven't occurred in the same fashion. And I'm afraid to say that the third reason is the performance of the gold equities during the last major increase in the gold price. If you'll remember back, and I'm sure you do, to the decade 2000 to 2010, in that decade, the gold price increased from about $250 an ounce to, if my memory serves me well, $1,800 or $1,900 an ounce. So you had a seven-fold increase in the gold price. And the free cash flow per share of the XAU fell. It took real skill for the industry to generate declining free cash flows per share when the selling price of their commodity went up sevenfold. Now, I suspect that that problem is, at least for a while, a relic of the past, in the sense that the management teams that presided over that destruction of value were all thanked and excused, allowed to pursue other employment opportunities. And I think that the institutional investors, myself included, have a real memory of that period. And we are looking at the interplay between the income statement and the balance sheets of major mining companies much more rigorously than we did in the past. In other words, I don't think that the managers would be allowed to be that stupid, even if they were predisposed to be that stupid. But I think until you see absolute growth in free cash flow per share on the XAU, that you aren't going to see broad increases in the gold price, in the gold equities that reflect the increase in the gold price. I think that margin expansion is going to occur in 2024, which means I think you will see companies like Barrick and Newmont begin to exhibit the margin increases that you're seeing in companies like Alamos and say Agnico Eagle. And if that happens, it's still an if. If that happens, I think you'll see a real romp in the gold equities. Traditionally, that romp has been led by the largest companies in the space. They have the liquidity to hold the extra money that comes in. But fairly quickly, when the big guys' share prices goes up, which means their cost of capital goes down, if the move doesn't extend to the mid-tiers, what happens is that the market arbitrages that out, which is to say the big companies with lower cost of capital take over the small companies with higher cost of capital.
To understand the full scope of why silver is positioned for a potential explosion, we must examine the economic indicators currently at play. These indicators are critical as they provide insight into the underlying economic conditions influencing investor behavior and market trends. Firstly, let's talk about inflation and the Federal Reserve's stance. Recent data shows a reduction in U.S. consumer prices for the first time in over 4 years, with annual inflation cooling to 3% from 3.3% in May. While this might seem like a positive development, it also indicates a slowing economy, which is why Fed Chair Jerome Powell has hinted at potential rate cuts. Powell's suggestion that rate cuts could begin even before inflation reaches the 2% target is a strategic move aimed at stimulating economic activity by lowering borrowing costs. Lower interest rates generally make non-yielding assets like silver more attractive. In a low-rate environment, investors seek alternatives to bonds and savings accounts, which offer diminishing returns. Silver, unlike these traditional assets, holds its value and even appreciates during economic downturns and periods of high inflation, making it a preferred hedge. The anticipation of these rate cuts is already influencing market sentiment, as seen in the recent climb in silver prices. Furthermore, let's consider the U.S. dollar. The dollar has shown strength recently, primarily due to the anticipation of Trump's potential re-election and the fiscal policies that could come with it. These policies are expected to inflate government debt and drive inflation, factors that typically support higher silver prices in the long term. A strong dollar usually restricts silver's gains in the short term because it makes silver more expensive for holders of other currencies. However, the broader expectation of increased government debt and inflation under Trump's policies could ultimately lead investors back to silver as a safe haven. In addition to domestic economic indicators, global market dynamics also play a crucial role. Optimism over Trump's re-election and the prospects of rate cuts have positively influenced global market sentiment. This has been particularly evident in Asian markets, where indices like Japan's Nikkei 225 and South Korea's KOSPI have seen significant gains. However, this global risk-on sentiment has somewhat restrained the advancement of safe haven assets like silver. Investors are currently favoring higher risk assets, anticipating regulatory easing and favorable fiscal policies under a second Trump term. Despite these mixed signals, the technical outlook for silver remains promising. Silver currently stands at $30.81, with immediate resistance projected at $31.24. The 50-day and 200-day exponential moving averages, EMAs, are at $30.84 and $30.38, respectively, indicating a potential bullish breakout if silver can sustain above the critical $30.87 pivot point. However, if silver slips below this threshold, significant sell-offs could be triggered. These technical indicators are vital for traders and investors as they provide a roadmap for potential price movements based on historical data. The intersection of these economic indicators in
territory for a market observer like yourself. I think that involves a lot about investor psychology. And I'm not very good at that. I can't even dress myself. I tend to confine myself to topics where I believe that my experience gives me an edge over competitors. And I don't have that edge in cryptocurrencies. I'm not suggesting that they're valueless. I understand conceptually the network effect. I understand the potential ease of transaction, the frictionless cost that could be offered. I understand too the anonymity. I just have a difficult time personally understanding some of the value propositions. And I also don't have 45 years watching the crypto market to begin to understand how markets might react to changes in news. So I will leave discussions of the crypto to people who are better market observers than I.
So I got to ask you about silver. Gold has already taken out its all-time high. It's trading at or near its all-time high, but silver is nowhere near it. Is this the year we're going to see a massive move in silver and it's going to take out that $50 level?
The truly honest answer is I don't know. I've never understood the importance of things like the gold-silver ratio. Those rules of thumb don't, to me, discuss utility. And I believe that price is a function of utility versus scarcity. And the fact that silver is 16 times more prevalent in the Earth's crust than gold is an example, or that gold has taken out its old nominal highs, and silver is only at 60% of its old nominal highs. I understand the observation, I'm just not smart enough to understand the relevance, if any. I'm also old enough and smart enough not to lock myself into a time frame like this year. Well, I'm tempted. Here's what I can tell you. When I look at the gold price,
Now let's explore the global market dynamics that are further influencing silver's trajectory. Understanding these dynamics is crucial as they provide context for the broader economic environment in which silver operates and how global events and trends can impact its price. The global sentiment towards economic growth and political stability plays a significant role in silver's market dynamics. Currently, there is a wave of optimism sweeping across global markets, particularly in Asia. The prospects of rate cuts by central banks, including the U.S. Federal Reserve, have fueled positive sentiment, leading to significant gains in major Asian equity indices. Japan's Nikkei 225 and South Korea's KOSPI, for instance, have both seen substantial increases as investors anticipate favorable economic policies and a more stable global economic environment. However, this optimism is a double-edged sword for silver. On one hand, a bullish global market can drive demand for industrial metals, including silver, which is crucial in various applications such as electronics, solar panels, and automotive components. On the other hand, the risk-on sentiment, where investors flock to higher-risk assets like equities, can somewhat restrain the advancement of safe haven assets like silver. This is because during periods of economic optimism, investors are less likely to seek the security that precious metals provide. Moreover, the potential re-election of Donald Trump as the U.S. president adds another layer of complexity. Trump's presidency is associated with significant regulatory and fiscal changes. His administration's approach towards deregulation and fiscal stimulus is expected to create a more business-friendly environment, encouraging investment in riskier assets. However, these policies could also lead to increased government debt and inflation, which traditionally drive investors back to precious metals as a hedge against economic instability. Additionally, global market dynamics are also shaped by geopolitical events and economic policies in other major economies. For instance, China's economic strategy, which has shown signs of slowing growth, is a critical factor. As the world's largest manufacturing hub, China's demand for silver is substantial, especially in its industrial applications. Any slowdown in China's economy can impact global silver demand. Recently, China's GDP growth has decelerated, and the third plenum of the Chinese Communist Party indicated no major changes in its economic strategy, which might suggest a continued period of subdued industrial demand. Furthermore, trade tensions between China and other major economies like the US and the EU also influence market dynamics. The imposition of new tariffs on Chinese electric vehicles by the US and EU adds to the uncertainty, potentially impacting China's manufacturing sector and its demand for industrial metals, including silver. In the midst of these global dynamics, technical factors also come into play. Silver's technical outlook shows it currently trading around $30.81, with key resistance levels at $31.24, $31.53, and $31.76. These levels are crucial as they indicate potential points where silver could break out into a higher price range. Conversely, support levels at $30.56, $30.20, and $29.88 are critical to watch as slipping below these thresholds could lead to significant sell-offs. The 50-day and 200-day exponential moving averages, EMAs, are also important indicators. With the 50-day EMA at $30.84 and the 200-day EMA at $30.38, silver is positioned for a potential bullish breakout if it can sustain levels above these averages. These technical indicators, combined with global market dynamics, create a complex but promising scenario for silver. As we piece together these global factors, it becomes clear why experts like Rick Rule are so bullish on silver. The interplay of economic policies, geopolitical events, and market sentiment sets the stage for significant movements in silver prices. Next, we will delve into Rick Rule's perspective on market manipulation and supply constraints, which are crucial elements in understanding the potential for silver to reach $2,000. Let's explore these insights to see how they further support the bullish case for silver.
An earlier ill-timed interview with me where I talked about the fact that silver lagged gold, that the price momentum had to be established by gold and then silver would follow through. And I was dumb enough to tell you that that might take a year. And I think it took 3 weeks. It still remains a historically observable fact going back 50 years that precious metals bull markets are led by gold. when the momentum is established by gold, for whatever reason, and your listeners could speculate for themselves as to why that is, that when silver starts to move, it moves further and faster. I also made the point in that interview that speculators should look at the junior silver stocks, should look at them in particular because they were hated. And the easy money in speculation is buying what's hated and waiting till it becomes less hated. That's occurred in 3 months. I'm not trying to say that all of the easy money has been made, but I'm trying to say that the hate around the junior stocks, the junior silver stocks, has dissipated. I learned 20 years ago from Doug Casey that the market capitalization of the legitimate junior silver stock universe, I'm not talking about all the petty pretenders in the silver space, but the guys with legitimate deposits, the market capitalization of that group of companies is insufficient to hold the capital that comes into the sector. When the generalist investor comes touring into precious metals, and I think you're going to see that if gold continues higher, which I believe it will, and if past is prologue, when silver begins to outpace gold, and the consequence of that is that people who are looking to employ the precious metals narrative crowd into the junior silver stocks. I remember past silver bull markets, and they're truly something to behold. I came into the business in the early 1970s, and I remember vividly Coeur d'Alene silver going from 10 cents a share to $65 a share. I don't know arithmetically what kind of return that is, but it's stupid for 10 years. I didn't participate because I was too young, too dumb, and too broke. But in the next silver bull market, I remember Silver Standard going from 72 cents to $45, Pan American silver going from 50 cents to $40 or $45. These are truly stupid moves if you have the psychological ability to stomach the volatility, and if you have the financial ability to speculate with some amount of money that you can afford to lose if you're wrong. It's worthy to note, by the way, and we've talked about this on your show before too, in all of those multi-baggers that I've enjoyed, I mean, none of them occurred over a long weekend, right? They take 5 years or 6 years to unfold. And in every circumstance, including Pan American and Silver Standard, during some period of time when they ran from below $1 to over $40, they exposed holders to 50% declines in share prices. And you need to be able to stomach that, both financially and psychologically. If you are, it's a very fertile place to speculate. And I suggest that in addition to that, probably now it's a timely place to speculate.
Let's take a closer look at the technical outlook for silver, which plays a critical role in predicting its future price movements and understanding the potential for it to reach $2,000. Technical analysis involves examining historical price data and market trends to forecast future price movements, and it's a tool widely used by traders and investors. Currently, silver is trading around $30.81, with a moderate increase of 0.43%. This price movement is significant as it situates silver just below several key resistance levels. The first immediate resistance is projected at $31.24, followed by further hurdles at $31.53 and $31.76. These resistance levels are crucial because if silver can break through these points, it could trigger a bullish trend, driving prices higher. Moreover, support levels are equally important to watch. These are the price points where silver tends to find buying interest, preventing it from falling further. The key support levels for silver are at $30.56, $30.20, and $29.88. If silver slips below these support levels, it could lead to significant sell-offs, driving prices down. A critical aspect of technical analysis is the use of moving averages, particularly the 50-day and 200-day exponential moving averages, EMAs. These moving averages help smooth out price data to identify trends over different time frames. Currently, the 50-day EMA is at $30.84, and the 200-day EMA is at $30.38. When the price of silver is above these EMAs, it generally indicates a bullish trend, suggesting that silver is in an upward trajectory. Conversely, if the price falls below these EMAs, it could signal a bearish trend. For silver to sustain its upward momentum, it needs to stay above the critical pivot point of $30.87. This pivot point acts as a psychological barrier for traders. Staying above this level indicates strong market sentiment and could lead to further price increases. However, if silver falls below this pivot point, it could trigger sell-offs as traders might see it as a sign of weakening market strength. Another technical indicator to consider is the Relative Strength Index, RSI, which measures the magnitude of recent price changes to evaluate overbought or oversold conditions. An RSI above 70 suggests that silver is overbought, while an RSI below 30 indicates it is oversold. Currently, silver's RSI is approaching the overbought territory, indicating strong buying pressure. However, if the RSI moves too high, it could suggest that silver is due for a correction. The Bollinger Bands, which measure market volatility and provide relative price levels, are also useful in this context. When the price of silver moves towards the upper band, it indicates overbought conditions, while the lower band suggests oversold conditions. Silver's current position within the Bollinger Band shows that it is approaching the upper band, indicating strong buying interest, but also hinting at potential volatility. These technical indicators provide a comprehensive picture of silver's current market conditions. They highlight the potential for a bullish breakout if silver can maintain its price above key resistance levels and moving averages. However, they also caution that the market could face corrections if support levels are breached or if indicators like the RSI suggest overbought conditions. Understanding these technical factors is essential for investors and traders as they navigate the market. They offer insights into potential price movements and help in making informed investment decisions. However, technical analysis is just one piece of the puzzle. To get the full picture, we need to consider other critical factors, such as market manipulation and supply constraints, which Rick Rule has extensively discussed. Rick Rule, a prominent figure in the precious metals investment community, provides valuable insights into the dynamics that could lead to significant price movements in silver. His analysis on market manipulation, supply constraints, and strategic acquisitions offers a deeper understanding of the forces driving silver prices. Let's explore these factors next to see how they complement the technical outlook and further support the bullish case for silver.
I don't want to give you a Canadian number because I don't know it. But in the US, the on-balance sheet liabilities of our government exceed $34 trillion. The off-balance sheet liabilities, though, Medicare, Medicaid, Social Security Trust Fund, military pensions, government pensions, all that kind of stuff, exceed, according to the Congressional Budget Office, $100 trillion. And we propose to meet these obligations with a budget that goes further into deficit by $1 trillion every 100 days. Now, how do we get ourselves out of this conundrum? Understanding that America's GDP is under $30 trillion, which is to say our GDP is less than our on-balance sheet liabilities and is 20% of a combination of our on-balance sheet and off-balance sheet liabilities. How do we solve this? Well, they say, tax the rich. Top 1% of Americans have an aggregate net worth of $5.8 trillion. If you stole the entire net worth of the 1% in the United States, you wouldn't have solved the debt. What you would have done is funded, something like 20 months of the deficit. So you got to throw that one out. Well, how about tax everybody else then? Good luck with that. How about curtailing benefits? Let's say to the old guys like me, hey, Rick, you voted yourself a whole bunch of cool benefits for 40 years. You forgot to pay for them. We're not going to give you the money. You follow me? There's a whole bunch of hard choices. And you know what? We faced those hard choices before. Not as hard, but we faced them in the decade of the 70s. We had unsustainably high debts. We couldn't raise taxes. So what did we do? We inflated away the real value of the obligations. The purchasing power of the US dollar over the decade of the 70s declined by 80%. So we didn't renounce the debt in the honest, old-fashioned way by saying, yeah, we owe, but we ain't going to pay. Too bad, too sad. What we did is we made the debt less important relative to the inflated dollars that we took in via taxation. So my suspicion is that the way that we deal with this $130 trillion obligation or series of obligations is that we, in effect, inflate away most of the present value of the obligation.
Now let's delve into Rick Rule's perspective on silver, which is a cornerstone of our understanding of why silver could potentially reach $2,000. Rick Rule is a highly respected figure in the precious metals investment community, and his insights provide valuable context for silver's market dynamics. Rick Rule is notably bullish on silver, viewing it as an undervalued asset with substantial upside potential. He highlights silver's dual role as both an industrial and monetary metal, making it particularly attractive in the current economic climate. Silver's industrial applications are vast, including use in electronics, solar panels, and automotive components, all of which are critical in a world increasingly focused on renewable energy and advanced technology. Rule points out that silver often lags behind gold in terms of price movement, but eventually catches up, often outperforming gold due to its higher volatility and leverage. This pattern creates significant opportunities for investors who can tolerate the volatility and have a speculative mindset. He emphasizes that while silver may be subject to short-term fluctuations, its long-term prospects are strong, driven by persistent supply constraints and increasing demand. One of the key factors Rick Rule discusses is market manipulation. He has spoken extensively about the sudden drops and rises in silver prices, attributing some of this volatility to the liquidation of leveraged long accounts and fluctuations in industrial demand expectations. Despite these short-term disruptions, Rule remains confident in silver's long-term potential. He believes that ongoing macroeconomic trends, such as inflation and currency devaluation, will continue to drive investors toward precious metals as a hedge against financial instability. Supply constraints are another critical aspect of Rule's analysis. He points out that silver's supply is limited and the increasing demand, particularly from industrial applications, exacerbates this constraint. Rule has been a strong advocate for investing in physical silver and has demonstrated his confidence through Sprott's aggressive acquisition of physical silver. Under his leadership, Sprott PSLV has become one of the largest buyers of silver, acquiring significant portions of the global mining supply. This strategy not only reflects his bullish outlook, but also contributes to the supply-demand imbalance that can drive prices higher. Rule also emphasizes the importance of investing in high-quality silver mining stocks. He advises investors to focus on companies with solid management, good projects, and sound financials. These factors significantly impact investment outcomes, as well-managed companies are better positioned to capitalize on rising silver prices. He often recommends that investors who are comfortable with higher risk and volatility consider silver equities as a speculative investment rather than a core portfolio holding. In terms of future predictions, Rick Rule remains optimistic about silver's prospects. He believes that the ongoing macroeconomic trends, such as inflation and currency devaluation, will continue to drive investors toward precious metals. Rule predicts that these factors, combined with industrial demand, will lead to higher silver prices in the coming years. His bullish stance is grounded in a comprehensive understanding of market dynamics, supply-demand fundamentals, and macroeconomic trends. Furthermore, Rule's analysis is supported by recent market data. The technical outlook for silver, which we discussed earlier, shows potential for a bullish breakout if silver can sustain its price above key resistance levels and moving averages. This aligns with Rule's prediction of a significant price rally, driven by both market fundamentals and technical factors. As we piece together Rick Rule's insights with the technical and market analysis, the case for silver reaching $2,000 becomes more compelling. Rule's perspective on market manipulation, supply constraints, and strategic investments provides a deeper understanding of the forces at play. Next, we will explore the specific investment strategies recommended by Rule and how they can help investors capitalize on silver's potential. Let's dive into these strategies to see how you can position yourself to benefit from the anticipated silver rally.
There needs to be some money left over for people to live on. There needs to be a little money left over to reinvest to make sure that the sustaining capital in the private sector continues to be strong enough that at least they can continue to tax. Meanwhile, in the United States, before local expenditure and before debt service, government currently consumes almost 40% of GDP. So how much can you raise tax? Particularly, how much can you raise tax relevant to the size of the obligation? Let's say, just for fun, and I don't think it'll happen, that you got around to balancing the US budget. which is to say you didn't increase the deficit anymore. How do you deal with the $34 trillion that you owe the bondholders? How do you deal with the $100 trillion that you owed folks like me for Medicare, Medicaid, and Social Security? Even if we found $3.5 trillion via increased taxation, we've shown arithmetically that that can't come from the billionaires because they don't have it. How do you deal with the debt?
Rick Rule's insights into market manipulation and supply constraints offer a nuanced understanding of the silver market, highlighting factors that could propel silver to unprecedented heights. Let's explore these critical elements to understand how they contribute to the potential for silver to reach $2,000. Rick Rule has been vocal about the manipulation of silver prices. He suggests that sudden drops and spikes in silver prices are often the result of large-scale market maneuvers, such as the liquidation of leveraged long accounts and speculative trading by major financial institutions. These actions can create significant volatility, which can be unsettling for investors. However, Rule emphasizes that while these short-term manipulations can cause price swings, they do not alter the long-term fundamentals that support silver's value. Rule points out that the silver market is relatively small compared to other financial markets, making it more susceptible to manipulation. This means that even relatively small trades can have outsized impacts on price. Despite these challenges, Rule believes that savvy investors can navigate this volatility by focusing on the underlying supply-demand dynamics and long-term trends. Supply constraints. Supply constraints are a critical factor in Rick Rule's bullish outlook on silver. He notes that silver is not only a precious metal but also an industrial one, essential for numerous applications in technology and renewable energy. This dual demand places significant pressure on the supply of silver, which is already limited. Rule highlights that mining production cannot easily scale up to meet rising demand. Developing new mines and expanding existing ones require substantial investment and time. Moreover, the quality of available silver ore is declining, making extraction more challenging and costly. These supply-side constraints create a favorable environment for price increases, especially as demand continues to grow. Sprott Strategic Acquisitions. Under Rick Rule's leadership, Sprott PSLV has been one of the largest buyers of physical silver, demonstrating a strategic approach to capitalize on supply constraints. Sprott's aggressive acquisition of silver not only reflects confidence in the metal's future, but also contributes to the supply-demand imbalance. By securing large quantities of physical silver, Sprott effectively reduces the available supply, which can drive prices higher. This strategy aligns with Rule's broader investment philosophy, which emphasizes the importance of owning physical assets in a market characterized by high volatility and manipulation. He believes that physical silver provides a tangible hedge against economic instability and inflation, offering a secure store of value. Investment strategy and recommendations. Rick Rule advises investors to consider silver as a speculative investment, suitable for those who can tolerate higher risk and volatility. He recommends focusing on physical silver and high-quality silver mining stocks. Rule stresses the importance of selecting companies with strong management, good projects, and sound financials. These factors are crucial as they influence the company's ability to capitalize on rising silver prices and manage operational risks effectively. For those looking to invest in silver equities, Rule suggests targeting companies that are undervalued and have significant growth potential. He often highlights junior mining stocks, which, despite their higher risk, offer substantial upside due to their leverage to silver prices. These stocks tend to outperform during silver bull markets, providing investors with opportunities for significant returns. Future predictions. Rick Rule's future predictions for silver are grounded in his comprehensive understanding of market dynamics and economic trends. He believes that ongoing macroeconomic factors, such as inflation and currency devaluation, will continue to drive investors toward precious metals. Rule predicts that these trends, coupled with industrial demand and supply constraints, will push silver prices higher in the coming years. His optimism is reflected in recent market data and technical indicators, which show potential for a bullish breakout. The convergence of these factors supports Rule's bullish stance and his belief that silver could reach $2,000. As we integrate Rick Rule's insights with the broader market analysis, it becomes evident why he is so confident in silver's future. Next, we will explore specific investment strategies and recommendations that can help investors position themselves to benefit from the anticipated silver rally. Let's dive into these strategies to see how you can capitalize on the potential for $2,000 silver.
Statistics around physical gold ETFs Until about 5 weeks ago, retail investors in the Western world, at least, were dishoarding or selling gold. The strength in gold has been central bank buying. Now, I would agree with your statement that gold traditionally does well in the context of inflation. But what's kicked this gold bull market off, really, I think, is the weaponization of the US dollar. If, as I believe likely, that the follow-through is retail participation on top of continued central bank buying, then I think, Jimmy, you see a real move in the gold price. And that's what I'm anticipating will occur.
So let's talk about the central bank buying in a little more detail. In 2022 and 2023, they acquired approximately 25% of gold production. That's continuing on into 2024. But what are the reasons why the central banks are buying gold so aggressively?
I think it comes to two general things. First is the weaponization of the US dollar. The US government has decided, in their wisdom, by the way, whether or not you agree with US policy, to export US policy to other countries who may have their own agendas. The weaponization of the SWIFT banking system, which is not US property, but the US government has decided to do anyway as a consequence of the fact that it's denominated in US dollars. And further, the theft by the US government of $300 billion worth of Russian holdings of US Treasuries. Again, whether or not you agree with Russia's policy or America's reasons to do so, has caused governments around the world who believe that they might come into the sights of the US government. As an example, the Russians, the Chinese, the Indians, the Saudis, to question their holdings of US Treasury securities and their...
Now let's delve into the specific investment strategies recommended by Rick Rule, which can help investors capitalize on the potential for silver to reach $2,000. Rule's strategies are designed for those who can tolerate higher risk and volatility, focusing on physical silver and high-quality silver mining stocks. 1. Investing in physical silver. Rick Rule strongly advocates for holding physical silver as a core part of any investment strategy aimed at capitalizing on rising silver prices. Physical silver provides a tangible asset that acts as a hedge against economic instability, inflation, and currency devaluation. Unlike paper silver or silver ETFs, owning physical silver means you have direct control over your asset, free from counterparty risk. Physical silver can be purchased in various forms, including coins, bars, and bullion. Rule emphasizes the importance of secure storage solutions, such as private vaults, to protect your investment. He also highlights the need to buy from reputable dealers to ensure the authenticity and quality of the silver. 2. Silver mining stocks. For investors willing to embrace higher risk for potentially greater rewards, Rick Rule recommends investing in high-quality silver mining stocks. These stocks provide leverage to silver prices, meaning they tend to outperform during silver bull markets. Rule advises focusing on companies with strong management, good projects, and sound financials. Criteria for selecting silver mining stocks. Management. Look for experienced and reputable management teams with a proven track record in the mining industry. Good management is critical for navigating the complexities of mining operations and maximizing shareholder value. Projects. Evaluate the quality of the company's mining projects. Factors to consider include the size and grade of the ore deposits, the stage of development, and the geographical location. Projects in politically stable regions with good infrastructure are generally more favorable. Financial health. Assess the company's financial health by examining its balance sheet, cash flow, and debt levels. Companies with strong financials are better positioned to withstand market volatility and invest in growth opportunities. 3. Junior mining stocks. Rick Rule often highlights junior mining stocks as high-risk, high-reward opportunities. Junior miners are smaller companies focused on exploring and developing new silver deposits. While these stocks are more volatile and speculative, they can offer substantial upside if their projects succeed. Advantages of junior mining stocks. Leverage to silver prices. Junior miners typically have greater leverage to rising silver prices, resulting in higher potential returns during bull markets. Growth potential. Successful exploration and development can lead to significant increases in a junior miner's stock price. Investors who get in early can benefit from substantial gains as the company progresses through various stages of development. Risks of junior mining stocks. Operational risks. Junior miners often face higher operational risks due to their smaller size and limited resources. These risks include financing challenges, regulatory hurdles, and operational setbacks. Market volatility. Junior mining stocks are more susceptible to market volatility and can experience significant price swings. Investors need to be prepared for this volatility and have a long-term perspective. 4. Diversification. Rick Rule emphasizes the importance of diversification within the precious metal sector. Diversifying your investments across physical silver, major mining stocks, and junior mining stocks can help manage risk and increase the potential for returns. This approach ensures that you are not overly exposed to any single asset or company. 5. Staying informed. Finally, Rule advises investors to stay informed about market trends, economic indicators, and industry developments. Regularly following expert analysis, attending industry conferences, and subscribing to reputable financial news sources can provide valuable insights and help you make informed investment decisions. By following these strategies, investors can position themselves to benefit from the anticipated rise in silver prices. As we have seen, the combination of market fundamentals, technical indicators, and Rick Rule's insights presents a compelling case for silver. In our final step, we will bring all these elements together to conclude why silver could realistically reach $2,000 and what it means for investors. Let's move to the apex of our discussion to tie everything together.
Last 5 weeks, my evidence comes from the ETF holdings. They have begun to participate. Why they didn't participate before is a matter of conjecture. My conjecture would be that gold is an instrument that reacts to fear. And we've lived through 40 pretty benign years, going back to the beginning of the lowering of the U.S. interest rate in 1992, all the way through 2022. Stock market was up, the bond market was up, there was lots of liquidity. I'm not trying to say there weren't some punctuations, 1987, 2008. We had some pretty dramatic punctuations, but the lessons that we learned as investors in those punctuations were that you'd buy the dips. The truth is that people were pretty optimistic because financial markets were continuing to do well. This reminds me a bit, frankly, of the late 60s and early 70s, when all of the indications of inflation were in the system, but people hadn't experienced it yet. They'd lived through 2 benign decades after the end of World War II. And while people read about inflation, it wasn't until they had sort of 5 years of experience with inflation. It wasn't until they'd seen the price of gas at the pump go from 20 cents a gallon to $1 a gallon, as an example, that they began to internalize the lessons. And I believe that the same process is underway right now. We talk about inflation, we feel inflation, we think about inflation's impact on others, but we've been schooled through 40 years of pretty benign economic climate to be aggressive, not cautious. Now, my belief is that after 3 years or 4 years or 5 years, people will begin to understand the price that they pay for the diminishment of the purchasing power of the dollars that they earn working or in their savings. I suspect that you'll look at the CPI, which suggests that, quote, inflation is moderate at 2.6%. But you'll look at what happens to the basket of goods and services that you purchase that impacts your lifestyle. And you'll say, wait a minute. The purchasing power of my dollars isn't decreasing by 2%. It's decreasing by 7% or 8%. And if you experience that over 5 years, if you watch your rent, as an example, if you were a renter, increase by 6 or 7% compounded. If you watch the cost of a shopping basket full of groceries increase by 100% over 4 years, all of a sudden you come to the same conclusion that retail investors came to in 1972 and 1973, which is to say all is not well. And I think it's that consciousness that really kicks off a market in the metal.
Now let's bring everything together and explore why silver could realistically reach $2,000 and what this means for investors. Throughout this video, we have examined various factors influencing silver prices, including market conditions, political influences, economic indicators, global market dynamics, technical outlooks, and Rick Rule's expert insights. Economic instability and inflation. One of the primary drivers for silver's potential surge is economic instability. As we discussed, inflation rates are cooling, but underlying economic conditions remain uncertain. Federal Reserve Chair Jerome Powell's hints at rate cuts indicate a need to stimulate economic activity, which often results in higher inflation over time. Silver, as a hedge against inflation, becomes an attractive investment in such scenarios. Historical data shows that during periods of high inflation, precious metals, particularly silver, have performed exceptionally well. Political dynamics. Political factors also play a significant role. The potential re-election of Donald Trump could lead to policies that inflate government debt and spur inflation, both of which are conducive to higher silver prices. The anticipation of regulatory easing and fiscal stimulus under a Trump administration has already impacted market sentiment, pushing investors towards riskier assets in the short term. However, the long-term implications of increased debt and inflation are likely to drive investors back to safe haven assets like silver. Global demand and supply constraints. Global market dynamics further support silver's bullish outlook. Industrial demand for silver is rising, driven by its essential role in electronics, solar panels, and automotive components. Meanwhile, supply constraints, as highlighted by Rick Rule, exacerbate this demand. Mining production is limited, and developing new mines takes significant time and investment. These supply constraints create a favorable environment for silver prices to rise as demand continues to grow. Market manipulation and volatility. While market manipulation can cause short-term volatility, it does not alter the long-term fundamentals that support silver's value. Rick Rule's insights into market manipulation highlight the need for investors to stay focused on the bigger picture. Despite short-term price swings, the overall trend for silver remains bullish due to strong market fundamentals. Technical indicators. Technical analysis supports this bullish outlook. Silver's current trading position around $30.81, with key resistance levels at $31.24 and beyond, indicates potential for a breakout. The 50-day and 200-day EMAs suggest a bullish trend if silver maintains its price above these levels. Moreover, the RSI and Bollinger Bands indicate strong buying interest, further reinforcing the positive sentiment. Rick Rule's strategic insights. Rick Rule's strategic insights into investing in physical silver and high-quality mining stocks provide a practical roadmap for capitalizing on silver's potential. His emphasis on physical silver as a hedge against economic instability and his recommendations for investing in well-managed silver mining companies highlight the actionable steps investors can take to benefit from rising silver prices. Conclusion. Bringing all these elements together, it becomes clear why silver has the potential to reach $2,000. The convergence of economic instability, political dynamics, global demand, supply constraints, market manipulation, and technical indicators creates a perfect storm for silver prices to soar. Rick Rule's expert analysis and strategic insights provide a comprehensive understanding of the forces at play and offer practical guidance for investors. As we conclude, it's important to remind viewers that investing in silver, like any investment, carries risks and requires careful consideration. The insights shared in this video aim to provide a well-rounded perspective, but viewers should conduct their own research and consult financial advisors before making investment decisions. If you found this video informative, please subscribe to our channel for more expert insights and market analysis. Stay tuned for our next video where we continue to explore the fascinating world of precious metals and investments. And remember, this is not financial or investment advice. Always make your investment decisions based on your own research and risk tolerance.
Use of the US dollar for international trade. A second problem, I think, is that the arithmetic around US Treasuries has gotten worse and worse and worse. We came through a period really of US dollar hegemony. I would suggest in the period 1982 to 2022, the internationalization of the US dollar and the decline in both nominal and real interest rates were tailwinds for gold. Now, I think that foreign countries in particular that look at the US dollar and look at US Treasuries see an instrument which pays them 4.3, 4.5%. I'm talking about the US 10-year, in a currency where, separate and apart from the CPI, they see the purchasing power of the currency decline by 7 or 8% compounded. And so they're stuck with this sort of a conundrum. You invest in an instrument which gives you a negative real rate of return, and you do so while exposing yourself to the risk of the extraterritoriality of U.S. policy. It's a real lousy bargain for those countries. It can't be any surprise that the Chinese, as an example, have reduced their holdings of U.S. Treasuries by about 70%, pardon me, over the last 5 or 6 years. In the first instance, they think that investing in their own economy and in their Belt and Road strategy around the world yields higher real rates of return than they would if they were invested in U.S. Treasury securities. And they also allow themselves to escape, at least in some sense, the extraterritorial imposition of U.S. policy through the U.S. dollar. So it's no particular mystery as to why foreign holdings of gold have increased and foreign holdings of U.S. Treasuries have decreased.